But let's get a view on the economic and investment landscape. Paul Ashworth from Cameron Harrison joins me live via Skype. Paul, thank you so much for your company today to, more or less kick off the new year, day 2 of 2023. For you, what's the lay of the land at the moment? What's the biggest issue this year? Is it that Fed outlook, understanding where the Fed hikes to, and perhaps as well, how long it keeps rates at that level?
Well, first of all, good morning and Happy New Year to you, Carl. Carl, I think there are a number of issues. That is the immediate issue at hand, is the management of monetary policy, given what has come before, post-GFC and through COVID, and the environment we find ourselves in. And of course, whether central banks can be successful in materially moderating inflation. Of course, most roads, of course, do lead to the United States, and in that respect, our position is, it's been fairly consistent over the last few months. That is, we have to see a material reduction in employment numbers, i.e. an increase in unemployment, to moderate wages growth. The problem in the US, particularly over the last 5 years, is they've had a structural adjustment to their employment market. We're increasingly seeing commentary in terms of their birth rate and what their intergenerational outlook looks like. But their immediate problem is excess demand. And they don't have a supply of labour, and they're going to have to, increase unemployment, and that is going to have to be for a sustained period of time. So until that occurs, yes, interest rates in the US, will have to increase going up.
One question I've been putting to a lot of guests recently is what perhaps you might have seen on your screen just before is this sort of rate cuts being priced in to say some point at the end of this year or perhaps the start of next. And one would assume based on that maybe markets are expecting inflation to come down so significantly this year that it's roughly towards the Fed's target. Do you buy into that view that inflation will come down quickly throughout this year, or are you in the camp that it might be sort of stubbornly high and that maybe these expectations of rate cuts eventually, or at least in the medium term, could be a little bit, let's say, optimistic?
Sure. Look, I think we need to, of course, look at inflation, in terms of, particularly in the US, because compositionally it's different in the US to Australia as to their measure. Yes, look, I think certainly goods inflation is moderating. We can see that occur, and that was, of course, the very big story last year, together with supply issues. In the US, they're key to sustain moderation of inflation is in terms of services inflation, which is particularly strong. That feeds into the low unemployment environment that they find themselves in, and their biggest component is shelter and rental, and I don't see that necessarily abating, such as consistent with market's expectations at the moment, and I think that's a general position that we see in the US in terms of capital markets. Is this desire, this wish, this hope, for favourable outcomes, over the course of the next 6 months, and that translates through to earnings growth in the US equity market. I just think there's this over optimism that prevails in the US. And I think the Federal Reserve will be particularly strong again until they see that meaningful data in terms of increased unemployment, such that they can get that moderation in wages growth and they can get the moderation in services growth.
So with that said, and I mean, it's more or less forecast by the Fed. If you looked at the statement of economic projections we did get last month, that the unemployment rate would have to rise reasonably significantly. We're talking about roughly 100 basis points from where it is now, maybe a little bit less than that. But is that to sort of say, especially with what you've just added there, that a recession in the United States is perhaps your base case, or what is even potentially priced into the markets right now as well?
Well, you could write our US economic strategy with that, Carl. That would be the headline. Yes, that has become our base case. We're not expecting it to be a deep recession, but you said 100 basis points. On our figures, to get wages growth, to a more moderate level, more in the 3 to 3.5 level, you need 1.5 to 2% unemployment. Now, I'm not suggesting that the Federal Reserve is going to drive to that ultimate end in a short period of time, but that gives you a sense of the scale, and if you want to call that an equilibrium, the level of unemployment to get to an appropriate wages outcome. Again, it just shows, I think the market is over optimistic relative to the job that the Federal Reserve knows that it needs to do.
Okay, so what about the asset allocation implications here then? Because again, if we talk about strategist notes, and if you ever need an offsider, of course, let me know. But a lot of folks talking about 2023 being sort of the return of fixed income, or at least the government bond as a well-performing asset class. Really the notion there that we are heading for a slowdown and that yields will have to fall, especially after the big sell-off we've seen in prices this year. Do you sit in that camp yourself, that perhaps now is a good time to allocate yourself, or maybe even be quite overweight government bonds?
Sure. Well, I suppose the first thing is one thing about predictions. Time eventually cures them, Carl. So yes, I think we can see that interest rates will moderate. I think it's important that our overarching view is that central banks do have the appropriate conviction. We don't think that they will be deviated from that course. It is a strong conviction. It is the inflation war that was won in the late 80s, early 90s, and they're not going to let that prize be lost. So we do think that the medium longer term duration fixed income market does see yield reductions over the course of the next 12 months. I think to answer your question, what is it that we're doing? Through the last few months of last calendar year, we have been slowly accumulating into high quality AA, AAA rated securities. Some government, some semi-government Quango type securities. We do think, particularly in Australia, the high fours, to mid 5.5% yields on, particularly on 5 and 6 year type duration. We do think that is, for that type of duration, quite good value, and has been is well priced. And that within our credit structure now represents about 35-40%, where previously it represented, say, the middle of last year, 18%. And I think that translates through in terms of other good duration assets. We particularly like listed property as opposed to private property. We think listed property has been unfairly dealt with relative to private property valuations and transactions. And we particularly like that space, in terms of warehouse and logistic assets, that have performed very well in operating income terms, and in cost terms, and in good hedging profiles, and sitting at 7.5–8% yields. We think again that they're duration assets that are particularly attractive. As to the specific timing shift here, we take a gradual approach or an incremental approach, and it's really where we want to find ourselves come mid this year in terms of our asset allocation. We typically being 8 to 12 months forward looking in terms of having our capital set.
What about equities? And you sort of mentioned duration there as well. I mean, perhaps in years gone by, you might have associated a move into duration with a rotation back into certain tech names, maybe not so broad-based anymore. But what about when it comes to allocating within the equity market? Do you think that there is going to be a shift back to perhaps those names? Will it be a bit more value-oriented this year? Of course, folks still talking about some supply-side issues that could, maybe be beneficial for energy markets or other areas of commodity markets as well. What's your view on equities more broadly? And if you are allocated to equities where you could potentially be, well, relatively overweight?
Sure. Carl, it's important to understand our approach. We tend not to do significant relative sector overweights. We're from a portfolio construction perspective, we're medium to long-term managers. We're strong advocates of largely equal weighting within our three geographies, which is Australia, the UK and the US. But in saying that, we have positions in healthcare that we've been continue to accumulate in. Again, it's this this theme of incrementally building our positions, given the economic financial market dynamics that exist at any point in time. The same is in terms of various staples, particularly in the US. But as I said, healthcare, certain drug providers in the US, in Australia, post, I suppose post-COVID, we've seen certain value emerging in terms of the radiology and diagnostic type stocks, the Sonics, the integrated diagnostic type businesses. On a more medium term, you mentioned energy. Over the last 6 months, we've rebuilt a position into Woodside. We think a business like Woodside's an important piece of the the energy transition story. In terms of gas and liquefied natural gas. So that they're positions that we've been building into. And I think in terms of the UK, we think Europe and the UK have a very hard 12 months ahead of them, and frankly, I think they've got a very hard 2 to 3 years ahead of them. But again, we start to see some good relative value, particularly in the UK in terms of they're very large multinational businesses. So a little bit of throwing the baby out with the bathwater. They're businesses that don't do a lot of business in the UK. They're large multinationals, and they represent good value. And again, we've been incrementally taking exposures into them. What else have we been doing in the US? Again, we see in terms of some of the quality house builders. They represent some reasonable value. They're not they don't find themselves in the positions that they did through the GFC. So again, we incrementally have been building positions into that, such that I think we do think through the second half of this year that we do see a better environment for capital metrics in terms of bond rates, and whether the market's pricing too optimistically at the moment. We do see an improved environment for risk going into 2024, and we'd like to be positioned for that come the middle of this year.
Paul, very comprehensive. Really, really appreciate it. I'll let you get back to your day and wish you obviously a happy new year. I hope 2023 is a very enjoyable and fruitful one. Paul Ashworth from Cameron Harrison, thanks for your time.
Thanks so much, Carl. Cheers.